Everyone wants to know the secret to picking the winning stocks. Wall Street makes it seem like you need 3 computer screens, a financial advisor homie, or even a doctorate in finance in order for this to work. But the truth is, the real investors aim for long-term plays instead of short-term flips. And today, I'm breaking down a 4-rule system that real investors use to pick the good stocks versus the bad stocks. And at the end of this video, you'll have a framework that you can use over and over again to build your wealth journey. Alright, without further ado, let's go ahead and jump right in. Rule number 1, only invest in strong fundamentals. Simple as that. If the numbers don't make sense, do not invest. And I know what you're thinking, Josh, how in the world do I know if the numbers make sense or not? Just give me a second, I'll tell you in just a moment. But since we're talking about stocks, these are companies that are public, meaning that they're available to anyone with a brokerage account to invest into their company. And each quarter, every company's CEO and CFO does what's called a earnings release. This is where they review their financial statements, talking about what happened in the prior quarter. And then later on in the call, they talk about what's called an outlook, where they're looking and forecasting for the future. This essentially gives investors enough confidence to invest in their company longer term. But without joining any earnings release, I'm gonna tell you how you can do your own research before digging in. The first one is track the consistent earnings growth. I'm not talking about the prior quarter or 2 quarters ago where the company is doing good. Their net profit would have to be climbing at least 3 to 5 years consecutively. And then that right there will tell you the business model actually works. The second one is manageable debt. See, if companies have to manage their debt, what's stopping you from managing your own personal debt? That's the exact reasons I talk about bad debt in my other videos. But a strong company borrows smart. They shouldn't be drowning in interest payments, because if something bad happens to the economy, like a pandemic or a recession hits, then they're in trouble. And the third one is high ROE. This is also referred to as return on equity. This measures how well a company turns shareholder money into profits. If they're good at multiplying every dollar invested, that's a green flag. The point is simple. When I'm on yahoofinance.com and I'm looking at the company's earnings, I'm seeing how they spend, how they reinvest, how they save their money, and how they manage their debt. And the businesses that survive have the strong fundamentals. Rule number 2, look for a competitive moat. It's all about the moat. And no, not the castle kind. In investing, a moat is what keeps a business competitive. It's essentially their strategic competitive advantage. Like, how do they separate themselves? And companies that are very competitive, they don't flinch whenever other companies show up. If a company doesn't have a moat, anyone can copy their product, lower the price, or even take their customers. But with a moat, the company is protected. They keep high profits for years and sometimes decades. And moats come in different shapes. The first one is brand power. Think about Apple. They're not selling iPhones, they're selling status. People line up and sometimes even live there just to get the newest iPhone. It's freaking crazy. People don't even get up early to look at the stock market, but they'll go to Apple and get an iPhone. I don't know what's wrong with you people, but that right there is brand moat. The second one is network effects. Platforms like Google, Facebook, and even LinkedIn get more popular as more people use them. The bigger the network, the harder it is for a competitor to break in. And to be honest, with those platforms, their value doesn't just go up monetarily. It also goes up in perceived value, which indirectly ties into moat. And the third is cost advantages. Walmart and Costco can keep their prices relatively cheap because how big their brand is keeps them competitive. And think about how many locations and stores they have at scale across the world. Competitors can't match without bleeding money, because in order to keep prices cheap, you have to have a lot of cash on hand, because profits are going to be lower. And the last is customer loyalty. Let's look at Starbucks. They're not just coffee. It's routine. People go back every day, not because it's their spot, but because they love the brand. And it's not even the cheapest option out there, but people keep coming back. When I was in my MBA program, a common theme was companies that last are the ones that build their moat. And when they're dominating their industries, they can't get crushed by other companies. Here's how I test this. I ask myself, If a brand new company comes into the market, will they crush me with cheaper prices or take my customers? If you can't answer that question confidently, then there's no moat. Get out. As we're going through these rules, you're making a smart investment by watching Money Talks Media. And if you continuously want intangible dividends, then go ahead and hit that like and subscribe button, because that move right there will pay off in the long run. Pun intended. All right, let's get back into the rules. Rule number 3, leadership matters. Y'all go ahead and sleep on this rule if you want to, but we're all human beings. Here's the unpopular truth. Great management doesn't just run a great company. It multiplies its value over time. But bad management can destroy billions literally overnight. A company could have the best product or service in the world, but if their leadership team sucks, then their company's gonna suck. Even if leadership seems shady or they're chasing short-term profits, or something just feels off, then they're probably not a good leadership team. Within my MBA program, we took an organizational leadership class. The professor was a beast, and she told me this one line that stuck with me. She said, "People don't quit companies, people quit bosses." And that holds so much truth when you really think about it. But for you, here's how you spot it. With CEO letters and shareholder reports, think about this. Are they transparent, or are they just throwing buzzwords at you? With the earnings calls, do they explain problems honestly? Do they answer your questions, or are they just hyping you up? In tough times, all companies have these every now and then. And this is a big one. When the company turns and sales drop, do leaders stay calm, or do they start pointing fingers and blaming others? My personal rule, if management sounds like hype men, then don't invest into the company. They're all supposed to be operators. Leaders are supposed to operate with clarity, with vision, to give you confidence as an investor. No manipulation, and definitely no storytelling that spins. Because in this video above, I showed you how this worked in real life, and they lost a lot of money. And we're wrapping this up with the last rule. Rule number 4, don't overpay. This one trips up a lot of beginners because we oftentimes get very happy and hyped up for a brand new company. Or even if it's an existing company, we oftentimes overpay. They'll tell a good story, we'll even convince ourselves to buy high, and only to watch the stock drop back down to reality. Now we're crying. And that's why valuation discipline matters. Look for these 2 metrics mainly. Look at the PE ratio. This is known as price to earnings. This tells you how much investors are paying for each dollar that the company earns. If it's sky high compared to their competitors, that's a red flag. The second one is DCF. This is known as discounted cash flow. This is more of an advanced tool, but it tells you how much the company has potential of generating money based on their projections. Warren Buffett says, rule number 1, don't lose money. And rule number 2, don't forget rule number 1. My personal gut check tells me this. Am I paying for hype, or am I paying for value? Patience is free, and opportunities always come back around. So just calm down a little bit. And now we're gonna finish off with the bonus rule. Size and security. Don't put all your eggs in one basket. No single stock should hold no more than 20% of your total investment portfolio. I don't care how much you believe in it. You never know where companies will go. Diversification matters. Spread it across sectors like tech, healthcare, finance, real estate, consumer goods, etc. And that's not just investing, that's survival. And you must look out for yourself. So the key takeaway for this video is the stock market is not about luck, it's about discipline. Once you follow the rules, you're not gambling anymore. You're being strategic and you're being an investor. If this has helped you simplify your investing, then I'm happy for you. Drop a comment below and let me know what stuck out to you most. Which rule will you apply in the future? But appreciate you watching. You're now an investor. Take care. I'll see you in the next one.